Good morning, everybody. Today, the important subject which I am going to discuss is income tax theory, law, and practices. See, when I say income tax theory and law and practices, it has 5 heads of income. One among them is income from house property. Now, today I am going to discuss income from house property. So, you all know very well, see how we are going to earn income from house property. The income which we earn from these houses, our buildings, our godowns, that we call it as rent. That may be called as rent. That may be in the form of rent. So, which will be coming under the head income from house property. The income under this head is not based upon the actual income from the property, but notional income or annual value of that particular building. So, house property is being divided into two important parts. One is let out property, another one is self occupied property. Again I tell you, house property is being divided into two major parts. One is let out property, another one is self occupied property. See, self occupied property, here we mean that the owner may be occupying the house. So, that is why we call it as self occupied property. In that property, from that property, there will not be any income at all. We won't receive any income. As far as the let out property is concerned, see, thus we are going to let it out. We are going to let the property to the third person, to another person. When we let it to another person, at that time we will be receiving income from that person, will be called as rent, which is in the form of rent. So, that comes under the head income from house property. And the self occupied property is again in two forms. One is one house, there may be only one house which is occupied by the owner of that particular house, and another one is, say suppose if the owner has more than one house property, in that case he has to convert one property, any one property should be as deemed to be let out property for calculation purpose alone. He has to calculate it, the self occupied property. If the owner has more than one house property which he occupies, in that situation he will be converting that property, any one property or more than one property will be converted into deemed to be let out property, and the procedure will be totally different, right. We see today the house property format, how it is, the house property will be. See, as I said to you that this house property is being classified into two. One is self occupied, another one is let out property. The format of self occupied property is, see, gross annual value. We will be starting from gross annual value. From gross annual value, we will be deducting municipal tax which is paid by the owner. Then after deduction, we will be getting net annual value. From net annual value, there are two deductions. They are standard deduction, another one is interest on borrowed capital. So, at last what we are getting will be called as income from self occupied property. And as far as self occupied property is concerned, since we do not receive any income from that particular property, so in that case we do not have income at all. So, that income we will be showing it as nil value. Gross annual value will be considered or is considered as nil, so that the municipal tax will not be deducted from that gross annual value. So, till net annual value the amount will be nil, we will be showing it as nil. And see, the net annual value may be calculated from the standard deduction, may be calculated from net annual value. When we do not have any net annual value, automatically the standard deduction as far as self occupied is concerned, that is also nil. Only one deduction which we can claim or which you can claim is interest on borrowed capital. So, after that, when we are claiming interest on borrowed capital, the amount when is deducted from the nil balance, the balance will be shown as minus balance. So, we get loss from self occupied property when there is interest on borrowed capital. Suppose if you do not have any interest on borrowed capital and there will not be any income at all under the head self occupied. And I come to this next part, let out property. When we talk about let out property, see, we are letting the property to another person. When we let the property to another person, See, we receive some income which is in the form of annual rental value. So, that is converted as gross annual value. Gross annual, the format of this let out property is gross annual value minus municipal taxes, then you will be getting net annual value. From net annual value, again you can have two deductions, one is standard deduction, another one is interest on borrowed capital. These two deductions you can claim under section 24. So, after deducting these two deductions, the income what you are getting will be called as income from house property, right. And as I said to you that we will be starting in the format, we will be starting from gross annual value. So, you must know how to calculate the gross annual value. See, to calculate the gross annual value, we will be following three steps, three important steps. They are, see, you will be comparing in the first step the fair rental value with municipal rental value. See, in abbreviation we call it as FRV and MRV. These two you have to compare. When you compare these two, in these two, whichever is the higher should be considered as one value. That higher value will be taking to the next step, that is to the second step. Higher value is compared to the standard rental value which is fixed by the government, and see, in these two the lower value should be taken in step 2, right. When we go to step 3, the step 2 lower value should be compared with annual rental value or actual rental value. ART, we call it as ARV or ART, annual rental value, right. In these two, the higher value should be taken into consideration. Now, see, the higher value is considered as, after completing the third step, the higher value is considered as gross annual value, right. So, I hope you can understand. So, the gross annual value, in the format you have the first step gross annual value, from there you are starting. To calculate gross annual value, you have to come across these three steps. The first step is comparing the FRV and MRV, and in these two the higher value is taken, and that higher value should be taken to the second step, and higher value is compared to the standard rental value SRV. So, in these two the lower value should be considered, and that lower value should be taken to the third step, and that lower value will be compared with annual rental value or actual rental value. So, in these two the higher value should be taken in the third step. The last higher value is considered as gross annual value, right. I hope you can understand what is gross annual value. From gross, again I repeat, the annual value of the property is deemed to be the sum of which the property might reasonably be expected to be let out from year to year. The income which the house owner receives is called rent or annual income of the property. Okay, this we can say it in terms of gross annual, in terms of meaning gross annual value. Then deductions allowed. So, first deduction is municipal taxes. From gross annual value, municipal taxes may be deducted, and after that you will be getting net annual value. After deduction of municipal taxes, what you are getting will be called as net annual value. So, municipal taxes levied by any local authority in respect of house property are reduced from gross annual value to arrive at the net annual value. Municipal taxes are deductible only if the following conditions are satisfied. So, there are three important conditions which we have to take into consideration. One is taxes should be paid by the owner. The municipal taxes are to be paid only by the owner. And the second point is actual payment during the year. See, made during the year. The payment must be made only during that particular assessment year or previous year. And the next one, municipal taxes or local taxes are to be paid, right. Taxes paid by the owner, actual payment during the year, municipal taxes are paid by the owner. So, I hope till this you can understand. Once again I will repeat, from gross annual value you will be reducing municipal tax, and after that what you are getting will be called as net annual value. This comes under the format of let out property as well as self occupied property, right. To calculate the gross annual value under let out property, as I said to you that there is a procedure, you know very well. See the points which I have given earlier, 3 steps are to be considered. See, comparing fair rental value with the municipal rental value, higher values should be taken. Step 2, higher values should be compared with the standard rental value, the lower values should be taken. And step 3, the lower value should be compared with the annual rental value or actual rental value. The higher value in these two will be considered as gross annual value. So, to calculate gross annual value, we have to come across all these 3 steps, and from this, see, you know very well, we will be deducting municipal taxes. So, after that, what you are getting is net annual value. From net annual value, see, there are again 2 deductions which we will be seeing tomorrow.